Hello, I'm Peter Herbert, and welcome to the latest in our series of short CPD webinars looking at topical accounting and auditing issues. In the 4 years that we've been running these monthly sessions, we've yet to touch at all on the topic of cash flow statements, what we often refer to as the forgotten statement within annual accounts, and one that regulators like the FRC and the ICAEW are quite critical of in relation to the way that they're prepared and the way that they're audited. Now, we're not going to delve too far into the theory of the production of cash flow statements on today's session, but what we're going to do very simply is have a look at an example of where a cash flow statement preparation could go wrong and use that to develop a checklist of possible points that you might want to include on an accounts preparation file or an audit file. So in terms of cash flows, we have, yes, our three main primary statements, don't we, in annual accounts: the balance sheet and the P&L and the cash flow statement. And I guess the sense of the cash flow being the underrated statement is that so often when annual accounts are prepared, the cash flow is kind of the balancing figure, isn't it, between the opening and closing balance sheet position and profit and loss for the period. Very much an afterthought sometimes, and that perhaps is why very often we can find issues in relation to its preparation. So let's have a look at an example of a cash flow statement scenario. Have a look at some of the issues that arise in relation to its preparation and think about things that we can do practically to make sure that these issues do not occur on a regular basis. So here's our scenario. We've got a company called Tamworth Transmissions Limited. It's a medium-sized UK company. It's experienced significant international growth in the last 2 years, and 30% of its sales are now to customers in the European Union. Accordingly, it has GBP and euro current accounts. On the next slide, we're going to show you the cash flow statement for the period. And what we want you to do is have a look at that cash flow and see if you can spot any issues in relation to its preparation. And if possible, what you might want to do is pause the recording while you have a quick look at the cash flow and see if you can spot any issues that have arisen. So on to the next slide, and here's that all-important cash flow statement. So there is, of course, the format for the cash flow statement under UK GAAP, FRS 102 and IFRS. It's very much aligned, isn't it, these days? We've got the three segments: the operating activities cash flows. That starts with cash generated from operations. We've referenced there to note 1. Now, don't worry about the fact I've not included note 1 in the case. That will be lurking within the notes of the accounts, which reconcile our profit to our cash generated from operations. We then deduct our interest and tax to give us our operating cash flow. We've then got our investing activities and the cash flows in relation to that. And then towards the bottom, our financing activities cash flows, and take those three aspects together. And that will then all reconcile, won't it, to the movement in the cash and cash equivalents figure in the balance sheet. So have a look at that and see if you can spot any errors, and then we'll run through what the issues might actually be. Okay, so this isn't necessarily massively complex. We've got some fairly basic issues that have arisen, but issues that we do stumble across quite regularly, certainly when we're reviewing audit files. The first thing I suppose to mention is we have got a couple of situations here whereby what would appear to be non-cash items have actually appeared within the main body of the cash flow. Now, two spring to mind here. First of all, we've got the reference under the investing activities cash flows to profit on sale of PPE. Now, of course, profit on sale of PPE is not a cash item. It's quite simply the accounting profit. And therefore, whether we've actually got a non-cash item within the investing activity section there, or whether it's quite simply poor labelling, I'm not sure, but that's certainly an issue I can certainly see there within that investing activities section. And then on the same line, really, in relation to the inclusion of non-cash items, an issue that I would say we come across very regularly is where you've got a situation during the year whereby you have a newly incepted lease, newly incepted finance lease or hire purchase agreement, giving rise to a movement in PPE and a movement in lease creditors, that then getting treated within the main body of the cash flow statement as a cash inflow and a cash outflow. And again, I appreciate that in reality, the substance of a HP agreement, the substance of a finance lease agreement is indeed a loan. But in terms of the actual physical cash movements, there are none at the point of the inception of the lease. The cash flows, of course, will come later when the lease payments are made. And of course, the capital element of those lease payments is treated as a financing outflow. The interest elements could be financing, could be operating. What we've got here is a movement in relation to cash flow in the bottom section. So funding for finance leased assets, 356. And we've then got a movement out, PPE purchased leased, which clearly, although the overall thing will balance by including those movements, by grossing up in relation to that newly incepted lease, those are non-cash items. They should be excluded from the cash flow statement and should instead be included within the reconciliation of net debt. Quite a common issue, although I appreciate in reality, quite an easy one there to get your head around. Another common issue that I would say that we stumble across if we're reviewing cash flows as part of our FAR review work is generally, I would say, what I might label, sort of categorize as fairly poor labeling. So again, think about the reader of the accounts, think about what they need to see in terms of the way that various cash flows are explained within the main body of the cash flow statement. We've already referred there, haven't we, to profit on sale of PPE. Again, if you were a preparer, we might know what movement in DLA means, but does that really make sense from the reader's point of view? Will they have the knowledge to understand what that really relates to? And in fact, what does that movement in DLA really represent in practice is the key thing there. And if we've had an injection of share capital in the course of the year, let's be clear about the actual amount of money injected in that financing section, rather than quite simply referring to increased share capital, increased share premium, and being too fixated, I suppose, and quite simply taking the balance sheet movements and copying them across line by line into the main body of the cash flow. More clear labeling about the nature of those movements, I think, will certainly be a regular issue that we do come across. And in the same vein, I suppose, one of the major movements there in the cash from financing activity section is other. I'm not saying that it's not possible to have an other movement section within operating, within investing, within financing, but where it's one of the major movements, can we break that down and be clear exactly what that other movement does in fact relate to? The final thing that you may have spotted, and this links back to the scenario on the previous slide, is we're told that this company does indeed have euro denominated as well as GBP denominated bank accounts. And remember, where that's the case, we will see what we write at the bottom of the cash flow, inclusion of the exchange differences on retranslation of those FX denominated bank accounts in terms of the overall reconciliation of the movements on operating, investing and financing to the overall movement in cash and cash equivalents. I suppose what I always think about there is that a FX denominated bank account is a monetary item. So from an accounting point of view, what we're going to have to do is to retranslate at the closing rate at the year end. That will therefore give us a debit or credit through our P&L, the exchange difference on retranslation, a debit or credit through the bank account as we retranslate to the closing rate. And what we'll do is we'll adjust for the P&L aspect within effectively what here is note 1, our reconciliation of profit to cash generated from operations. And then to make the cash flow balance, the same exchange difference will also pop up at the bottom when we're reconciling our overall cash flows to our movements in cash and cash equivalents. And that's not clear in the cash flow here that exchange difference has been thought about and has been factored in to the overall movements there at the foot of the statement. So not inordinately complex issues, but issues that do crop up quite a lot day to day. And as I say, if the cash flow is very much an afterthought, know these issues can get missed. And these, I think, are the sort of issues we do see and are therefore ones to be thinking about, certainly day to day, if you're preparing or indeed auditing cash flow statements on a regular basis. So to summarize from that scenario, I would say think very carefully about the treatment of the non-cash items. Non-cash items should be excluded from the main body of the cash flow and instead incorporated within the net debt notes. Think about the labeling Does the labeling make sense to a reader as well as to a preparer of the cash flow statements? Make sure that where you've got material FX denominated bank accounts, those exchange differences are properly treated, not only in the P&L, but also, as we've mentioned there, at the foot of the cash flow statements. And as I say, other is fine where the quantum is small, but where other movements are significant, do think about breaking them down, analysing, and therefore providing more useful and informative information for the reader of the financial statements. Okay, the second aspect, as I say, is thinking about what that means practically day to day in terms of, ideas for improvement and making sure these cash flows are fit for purpose. I've mentioned at the start, there's been some quite hard feedback from regulators. This particular thematic briefing, which the FRC produced a couple of years ago, is really helpful for those that are auditing cash flows to give people a sense, I suppose, of where things can go awry. So that is certainly well worth a look. And certainly in terms of the feedback in that briefing, there's certainly recommendations there from the FRC's Executive Director of Supervision that audit firms think very carefully about how they do indeed undertake the audit of cash flow statements. And we do indeed see, as I would say, certainly on some audit files, quite good checklists in the completion section to evidence that that particular cash flow audit has been, performed in a fairly robust way. Other times, less so. And what I thought I'd do to wrap up this short session today is perhaps give you a list of maybe 7 or 8 things that might be useful to certainly think about in terms of a checklist to certainly include in that completion section, just to make sure that these cash flows are indeed on a day-to-day basis, fit for purpose, whether you are a preparer or indeed whether you are an auditor. So what might we think about? Well, first of all, have we checked for consistency with other primary statements? One point the FRC thematic briefing on the audit of cash flows makes really clear is that very often cash flows are produced by corporates with the aid of spreadsheets. And if that's the case, are any late adjustments to the accounts that are being put through the accounts production software being appropriately and completely captured within the cash flow statement? So that would again be one to think about, certainly in terms of that consistency check right at the end, off the back of any final adjustments that have been made off the back perhaps of the audit. Have we checked for incorrect treatment of non-cash items? As I say, it's a fairly straightforward point, but one that crops up, I would say, more often than you think in practice. Have we identified any judgments? And if so, have we challenged management? This is a point I think that the FRC thematic briefing makes quite a big play on. And I appreciate that in reality, day to day for fairly simple businesses, there may not be a huge amount of judgment involved in the preparation of the cash. It's probably more of a mechanistic process. But for example, there might be sort of judgments around where certain movements go within the main body of the cash flow. So interest paid, for example, can get treated as an operating cash flow, can get treated as a financing cash flow. Is the treatment consistent? And does it make sense based on the substance of the payments being made in that regard? There can also be judgments around what we mean by cash and cash equivalents. You saw probably in the example there on the previous slide, we included movement in bank overdraft in the overall movement in cash right at the foot of the statement. And that's fine as long as the bank overdraft is genuinely being used as part of the day-to-day cash management of the organization. So these are issues where you've got an absolute choice. There's judgments. Have we thought about situations where judgment's being brought to bear? Have we challenged management appropriately in those situations? And have those challenges really made their way onto the audit file to evidence, I suppose, that we've indeed had those conversations? We talked about the importance of clear and accurate labeling. We talked about the importance of making sure that FX movements have been appropriately dealt with. The one example I've mentioned there is where you've got FX denominated current accounts that form part of cash and cash equivalents. Have we thought about appropriate treatment in relation to group adjustments? There's an element of complexity involved, for example, where you've got maybe a set of group accounts where you've made an acquisition during the course of the year and how cash movements in relation to that acquisition get dealt with within the consolidated cash flow statements. There are also complications around the way that you treat, for example, payments of dividends to non-controlling interests. Have those slightly more complex areas being appropriately dealt with within a group situation. And one that crops up very often, I would say, on our reviews, has appropriate use being made of exemption statements. If you're looking at, again, at a set of consolidated accounts where you've got the parent figures and the group figures presented together, very often what you'll find is you've got the group cash flow in the consolidated financial statements, but the parent company cash flow is excluded. Now, that exclusion is not automatic. To take advantage of the ability to exclude the parent cash flow from the consolidated financial statements, what you would need to do is to use the FRS 102 reduced disclosure framework and make reference to that in the notes to the financial statements. That often, I would say, is a statement which goes missing, and therefore that exclusion is not justified in practice. So just a few thoughts there about things that might be worth including in a checklist. I appreciate those are very much, I suppose, accounts preparation orientated, but I guess if the actual accuracy of the cash flow is there, and if it complies with the requirements of FRS 102 or IFRS, then I suppose that gets you a long way down the road. So those 7 points in themselves, I suppose, if they're addressed at least, gives you a fighting chance of ensuring that cash flows you're preparing or indeed are auditing are complete, accurate, and therefore fit for purpose. Okay, I hope you find that useful. We've got a longer 3-hour accounting update coming up on our public program in April. So if you want to attend that, do feel free to enroll. The details can be found on our website, www.insight-training.co.uk. Any queries about this particular session today, do drop us an email, inquiries@insight-training.co.uk. Okay, hope that was useful, and I'll speak to you all again soon. Goodbye.